Next question. Consider following information. There are two securities provided to us, X and RF. Returns are given as 18 and 10. Standard deviation is 20 and question mark. And we understand that this is 0 unless specified otherwise. Mr. A has rupees 10,000, comma, he borrowed rupees 5,000 and made investment of rupees 15,000, that is 10,000 plus 15,000 in security X. The first question is, what is the return in a rupees term? That is the first question. Everybody is requested to go through the question, please. Let us see how to make the calculation of answer. The first question is calculation of the return in rupees term. See what happens that's over here. We understand that say this 15,000 rupees of the investment is going to give return to us at the rate of 18%. So please use your calculator. 15,000 into 18%, that comes to rupees 2,700. That is the income that say you are going to generate. Because in absence of an information, we assume that the investment is going to generate the return as what we anticipate. So this return is consisting of the dividend income and also the price change of the security. Now the 5,000 rupees is borrowed. Now what is the rate of interest at which the funds have been borrowed has not been given to us in the question. And this question that we are doing is as a part of the Markowitz model, wherein an assumption is made that the borrowing will be at the rate of risk-free rate of interest. We understand that say the central government, state government, they are borrowing at a risk-free rate of interest. So we understand that say the borrowing at a risk-free rate of interest is possible only for say certain entities only, and in that say like the rate of borrowing will be RF. So accordingly over here we are required to solve the question. So 5,000 rupees into 10 percentage, the amount of the interest payment will be 500. So what will be the net income? 2,200. This is the income that you are able to generate on investment of 10,000. So what will be the return in percentage term? It will be 22%. That is the way the answer for the second part of the question is required to be found. Answer for the second part of the question. In that we understand. Answer for the first part. In that write down regarding borrowing of funds, comma, we assume that borrowing is made at the rate of risk-free rate of interest. Full stop. Government is borrowing at the rate risk-free rate of interest. Full stop. Calculation of return in rupees term, in that income minus interest payment. So this 15,000 rupees is able to generate a return at the rate of 18%. That comes to 2,700. minus borrowing of 5,000 at the rate of 10 percentage, that is 500, and ultimately it comes to 2,200. This is the answer of the first part of the question. Second question is return of portfolio or return in percentage term. In that, income upon investment in 200. What is the amount of income? 2,200. What is the investment? 10,000. Into 100 for getting answer in percentage term, and that comes to 22 percentage. Importantly, friends, understand that we already have considered the payment of the financial charges on the borrowing of the funds in calculation of the net income. So, as far as the investment is concerned, the investment will be taken only 10,000 rupees. That is the way the return will be calculated. Third question, calculate the weight of security X, weight of risk-free security in the portfolio, and with that compute the return of the portfolio and the risk of the portfolio. That is the question. So let us see how to make the calculation of answer. Answer for the third part of the question. Calculation of return of portfolio, comma, standard deviation of portfolio, and weight of individual security. That is the way we are required to compute answer of the question. Now friends, over here we understand that weight of X will be calculated as amount of investment divided by amount held. What is the amount of investment? 15,000, and amount held was 10,000. So dear students, its weight will be 1.50. As far as the WRF is concerned, weight of RF, in that it is amount borrowed divided by amount held. What amount is borrowed? 5,000 divided by amount held was 10,000. So the answer is negative 0.50. Dear students, in order to consider the effect of the payment of the interest, we have to take the weight of the risk-free security as negative. Why? Because we have borrowed and we are making investment. That is the reason. As far as the return of the portfolio is concerned, it will be found like this: weight of X into return of X plus weight of RF into return of RF. What is weight of X? 1.50. What is return? Sorry, weight of X is 1.5. Return of X is 20 percentage. Sorry, 18 percentage. Plus negative 0.5 into return is 10 percentage. So 18 into 1.5 is 27 minus 5. That comes to 22 percentage. This is the way we are required to make the computation of the return of the portfolio. And lastly, standard deviation of portfolio. As far as standard deviation of the portfolio is concerned, again it is very simple. It is weight of X into standard deviation of X. What is weight of X? 1.50 into standard deviation of X is 20 percentage. So 20 into 1.5, that comes to 30%. This is the way standard deviation of the portfolio can be calculated. And dear students, you can see that this 22% answer is what you are able to match over here also. That is the way the return of the portfolio is 22%. Now see friends, the question is done. There is nothing great to be done in the question. Yet I want to give some explanation more to you. Dear students, you might have that is studied a concept given a name as trading on equity. What is trading on equity? Trading on equity is a concept which shows the impact of the leverage, that whenever you raise the debt financing in the capital structure, then in that case, so the return to the equity shareholder increases, and that is what we understand is called return on equity, that is the trading on equity. See over here, something like this only happens. You had an amount of 10,000. On that, say you were earning at the rate of 18%. So your income was rupees 1,800. On this 5,000 rupees, say of the additional investment that you have made, the rate at which you are able to earn is 18%. However, your cost of capital is 10%. So what happens at say, why? Because you are borrowing at the risk-free rate of interest. So you get surplus of 8%. That comes to 400. So that 400 rupees of the additional earning is added to this 1800. So 1800 plus 400, that is the way the overall return comes to 2200 on investment of 10,000. So the return in percentage term comes to 22%. This is the way we understand that say when you borrow, your return increases like this. However, at the same time, what happens that say when you borrow and invest, then the risk is also bound to increase. Why? Because whatever the investment that you have made may not be able to generate the return as what you had expected. Even in that case, say your payment of the financial charges is certain, so risk increases. So this information is exactly the same as the previous question that we have done. So in that this table, if at all I add portfolio number 4, in that say the weight of RF is negative 0.5, weight of X is 1.50, return is 22%, and standard deviation is 30%. This is the return, and say this is the risk. This is 30%. So if at all you borrow and invest, then in that case, so the risk of your portfolio increases. That is what we understand. Chalo, let us with paragraph. Based on above working, comma, we can conclude that A, whenever there is a borrowing, comma, it is at the rate RF. B, for borrowed funds, comma, weight will be taken as less than 0. C, with borrowing, comma, risk and return both increase. Full stop. Let us see the next question. Plot the above figures on a graph paper, including return and risk calculated in the previous question. So friends, over here, whatever the table that we have prepared, for that the risk and return is required to be plotted on a diagram. On x-axis, we will take always an independent factor, that is standard deviation, and on y-axis, we will take dependent factor, that is return. This is a 0. Now over here, we are required to plot the risk and return of the above 4 portfolios that we have calculated. So friends, over here there are 4 portfolios. In that, say we have a situation like this. On x-axis, I am taking standard deviation. We understand that say when the risk is 0, then the return is equal to RF. That is 10% over here. That is return of the portfolio. Now, gradually when the standard deviation increases, return of the portfolio also increases. So when you move from the risk-free security to risky security, then in that case, along with the risk, return increases. So risk is 10% over here, and so the return is 14% over here. That is 50% investment is made. This is 20%. That is investment is made only in security X. In that case, the return is 18%. When you borrow and invest, then in that case, the risk increases further. Let us say to 30%, and the return increases from 18 to 22%. This is the way, so the return and risk, both of them are increasing. Over here, we understand, of course, that say this line will go like this for infinite value. This is the way we can draw the diagram. Technically, friends, we understand that say this portion is indicating investment is made in RF and X. That is what this is indicating. And this in portion is indicating that funds have been borrowed and investment is made in security X. That is the way we have the investment that has been made in security X with the borrowing of the funds. And of course, dear students, you understand that say more and more you borrow and invest, the risk increases, and along with that the return will also increase. That is the reason say this line is going for infinite value. This line is going for the infinite value. This is what we understand. Over here, friends, one more important point that you can see is that say this is a straight line. Why? Because there is proportionate increase in the return and the risk also. So when you shift by 50%, you can see that the risk increases by 10 and the return increases by 4. Another 50%, risk increases by additional 10 and the return increases by additional 4. Again 10 and again 4. That is the way, so we will be having the increase in the risk and return proportionately. That on a small note for this. From above working, we can conclude that the risk and return both of them change proportionately, comma, with shifting from RF to X and vice versa. There is a possibility of unlimited number of portfolios, comma, as there is no restriction on borrowing. Full stop.